Thank you, Jeff. Hello and welcome to the business segment of our daily news. I'm your host, Abdullah Nada, and today we'll be talking about the economic bomb and how to benefit from the economic bomb. The economic bomb, as it's known, the global pandemic that's going around nowadays. But how does a biological virus affect our economy? Well, one thing, it's business. Many small companies and small businesses are not getting customers, they're not getting clients, so it's just a matter of time until they declare bankruptcy. However, there's an investment that could help us reverse what this virus has done to our economy, and it's value investing. And luckily, today we have a professor from Harvard University to help and explain for you guys what value investing is. Hi, Mr. Yusuf, how are you today?
I'm doing great actually, thanks for asking. It's been rough actually this month with the coronavirus and everything, as you mentioned.
Yes, indeed. You talked about a new strategy, value investing, in one of your podcasts. Can you can you explain more to the viewers what value investing is and how it could help us at this time and moment of economic downfall?
So, value investing is, in my opinion, one of the most essential investments in the market as of now. This is because, as you stated before, the coronavirus is taking a big hit in our economy since there's less people are investing in products. So, basically, companies and even small businesses will go bankrupt eventually in approximately 3 to 4 months or even more. So, and first of all, value investing is not just any investment in a cheap company or anything. No, it's the research on finding a good quality company that is going through a, let's say, a financial problem or even a fundamental problem, any fundamental problem, and investing in that company you know that in the near future they're gonna go by that crisis. So let's say a company is usually paying 25% per share. And after the coronavirus hit, their value decreased to 10% per share. And it's known to be a good quality company. Investing in it will benefit you as you know that the shares will increase and you are gonna benefit yourself. This has no effect in the company itself. It's just benefiting you as a investor. And this is essential to small businesses as this will keep them in the market instead of go bankrupt in the near future.
But Mr. Yusuf, aren't you taking advantage of these companies by buying shares only when their share prices have dropped?
No, definitely not, because their method is about determining the worth of the underlying asset. So basically, value investors do not pay any mind to the external factors affecting a company. So these external factors could be day-to-day fluctuations, it could be security, and etc. So these factors do not have an impact on the company. So if let's say we, as value investors, invest in a company, as stated before, that is going through a fundamental crisis, right? This is we're not technically taking advantage of that. It's definitely going to benefit us, but at the same time, we're not having an effect on the company itself. Right? We're just investing in that company. We're not taking any of the factors affecting the company with it.
Well, what about the value stocks? What are the investors looking for in their stocks?
So a value investor would look for a company that has their share price less than, you could say, it's usually two-thirds of the real value. So basically, a real value is the company's stocks, their product, their currency. So it's just a mixture of all of them. So as stated before, the value investor would try to look for a company that has basically a less share ratio than other countries, other companies. Sorry. So, which brings us to the second point, the P over E ratio. So, let's say, for example, a company has a 20% share value, and another company has 50% share value. As stated before, a value investor would go for a company that will usually focus on a company that has 50% because he wants a cheaper and a better, well, it's usually a better because it's cheaper price, as both of these companies have good qualities. So then we go to the third point, which is the PEG, and this should be less than 1. PEG is usually the measure of how cheap the stock a company has, while taking into account its earnings and growth. So a company should have at least less than a ratio less than 1. This is because a value investor wants the shares to be cheaper and basically benefiting on the process.
But how safe is it for the value investor? Like, could the value investor lose a huge sum of money? What are the risks that the value investor is taking when he decides to value invest?
So any investment usually has their own risk. For a value investor, he would, as you stated before, would lose a lot of money instead of gain more. And there's this thing called the margin of safety, and it's basically a strategy to prevent this kind of risk. So let's take a normal case scenario where a stock is approximately, let's say, $30. This price would obviously fluctuate, either go up or go down. So if you want to pay for that stock, what should you do? What is the same thing to do? Pay more, $35 or even 40. So when the price fluctuates, let's say it comes 32 or 33, you pay 35 instead of paying the actual 30 because the price just went up. Same thing with value investment. It is basically a practice of leaving room for error in your calculation of the real value of the stock itself. So a value investor may be confident that a company has a real value of, as stated before, 30% share. Alright? But in case of his or her calculations are a little optimistic, the value is, let's say, 26. So you're assured that you paid 30, but the actual value is 26. Now you're in a safe zone. The value investor is a safe zone. And if let's say the stock's real value is lower than the investor estimated, so let's say the real value is 26 and you invested no, actually, if the real value is lower than what the investor estimated, so estimated the price and the real value is actually lower, the margin of safety would help prevent this investor from paying too much.
Mr. Yusuf? Mr. Yusuf? Apologies, ladies and gentlemen. I think we might have lost our connection with Mr. Yusuf, but I would like to assure you that value investing is a safe and secure way to help our economy recover from this crisis. And even though it might not seem as a sexy investment, but it's gonna have a good effect on the companies and the investors in the long term. And that was to wrap up our business news. And this was your host Abdul Nada. Until next time, see you.